Hi, I'm Steve LaFrance with Blakely Financial, and this is our final update until 2024. What a difference 1 month can make. If you listened to last month's update, you'll recall my summary of experiencing 3 consecutive months of market declines in August, September, and October. Then November came and everything is up. S&P 9.1, small caps 9.2, corporate bonds 7.5, high yield 4.9, international 8.2, and emerging markets 7.8%. One of the biggest reasons was the decline in Treasury yields, providing relief to bonds, helping the bond index achieve its first gain in 7 months and its biggest monthly gain since 1985. The S&P also recorded its largest gain since July 2022 and currently trades less than 5% below its all-time closing high. Tech was the top performing sector as the NASDAQ, now trading at its all-time high, gained 10.8%, propelled by mega-cap growth stocks such as Microsoft, Apple, and Nvidia. The real estate sector followed close behind, also benefiting from falling rates. And defensive sectors, including consumer staples, utilities, and healthcare, lagged as the market traded higher. As we take a peek at 2023's year-to-date returns, you'll see a sharp contrast between mega-cap growth stocks and the more defensive, yield-paying value stocks, 36.4 versus 5.4% to be specific. And you also see a similar difference between large growth versus mid-cap and small-cap stocks. This is largely attributed to 7 tech stocks known as the Magnificent Seven. They were hammered in 2022 with a 48% drawdown, but now provide narrow leadership in 2023. Take them away from the index, and the remaining 493 stocks of the S&P is up only 7% year to date. This will ultimately explain portfolio returns depending upon how you're positioned, since we don't often see these kinds of spreads in performance. In contrast, November's returns achieved a respectable amount of balance between each of the equity styles, and we hope this trend continues. Otherwise, investors may become tempted to chase those returns. Job openings are creeping down and unemployment is creeping up. But both are coming off historic values, still remain in healthy range, and reinforce our solid and resilient domestic economy. However, if these employment trajectories continue for another few months or more, the economic picture changes. This is a good problem, particularly among those looking for the Fed to lower rates sooner than later. Like I said before, good news is bad and bad news is good at this moment. Overall, investors are optimistic as the U.S. economy continues to exceed expectations. Q3 GDP was recently revised higher to 5.2%, the strongest since Q4 21. While unemployment sits at a 21-month high of 3.9%, it remains low by historical standards. Pending home sales recently fell to the lowest level since 2011, but the decline appears to be linked to limited supply rather than weak demand. The S&P earnings grew year over year during Q3, the first time in over 12 months. Inflation pressures have eased significantly, and investors expect multiple rate cuts in 24. There's a growing sense that the Fed has accomplished its mission of lowering inflation without tipping the economy into a recession. And the market will be watching closely to see if this strength carries into 2024. That's all for now. We hope you, your families, and your friends all have a happy holidays. Take care of yourselves, and thanks again for your trust and confidence.